Hi, and a very warm welcome to all the viewers and Prabhanjan from Dubai. We are shooting in yet another episode of Beyond Boundaries under Talk of Town, wherein we discuss not just the Indian markets but the global markets, the global factors that is influencing the markets, and how we expect the week to pan out. We have with us Prabhanjan from Dubai, a SEBI registered investment advisor from Elysian Advisory. And I am here filling in for Lakshmi Narayanan, just like I did a couple of weeks back. I'm playing the role of a host as well as giving my opinion, my technical opinion on how the markets are going to pan out for the next 1 week to 10 days. And I'm also representing Torah Tori Wealth. So just for the benefit of all our viewers, DA Capital now stands. The name stands changed to Torah Tori Wealth. So we are a bigger firm now. So very happy to announce this to all our viewers, and thank you for all your support and well wishes, and most importantly, the clients who have been the backbone of our company for a very long time. So thank you once again, and without much delay, Prabhanjan, we'll make the episode interesting without LN2. So I may not have his one-liners or punching dialogues during the course of this video, but we will try and make it as interesting as possible. So over to you, Prabhanjan. How do you see the macros playing out predominantly on the global front? I know there is a lot of development happening on the US trade tariff war, more leaning towards India, favorable to India. Before we come to the Indian markets, I just want to get your opinion on how the fundamentals are looking on the global platform.
Great. Good morning, Ashwin, and good morning, market viewers. If market volatility is like masala, this week's thali would blow the lid off the pressure cooker. Ashwin, you be ready. Today's serving is very hot, spicy, and full of flavor. And
Wonderful.
before I get on to the global market, many congratulations on the Total Wealth. As you rightly mentioned, it has become a very big platform. And congratulations, and I wish you all the very best, yourself and all the viewers and Ellen and all the people who are associated with Toratori.
Thank you so much,
Coming on,
Prabhanjan.
thank you so much. Uh, Coming on to the episode's main trend, let me just give a quick update on the main parameters. How did the crude, that flare? It's almost on the same parameters of
Yeah.
last week, which is around hovering around 66 to 66.5. Dollar index, the same case, 97.5 to 97.6, more or less, they are stable.
Yeah.
Rupee, on the other hand, bit appreciated. It came about 88.09 levels. But one
Mhm.
interesting thing, very interesting thing to note is on the India VIX. You know, India VIX has dropped to 15 to 16% month on month, and it is
Yeah.
currently hovering around 9.9 to 10 levels. It's near its lowest end of the 52-week range. I mean, if we take the range, 8.98 was the very low that was made, and high was 23.18. So we are hovering around those 52-week levels. So we'll talk more about it. What is the impact? Why it is when we talk about Indian markets? Um, so these are the parameters, and coming to the US and global events, and of course, US being the mother of all the markets, what has flared is US stock indices closed at near record highs again.
Yeah.
S&P 500, Nasdaq, and Dow all poised gains. The small caps has had mixed results. Russell 2000 outperformed somewhat over the week, but slipped on a Friday. U.S. equity funds, saw substantial outflows. It's because of mainly because of the profit booking. If we put a figures for that, it's about 43.2 billion. It was like, there was an outflow, especially from the large and the tech sectors. Bond funds and fixed income attracted inflows, while money market flows saw some sort of an outflows. Of course, oil prices drifted slightly down amidst demand concerns, even with the recent Fed rate cut boosting some optimism. Now, if we understand what are the major drivers, to me, it is like the Fed rate cut and policy expectations. the Fed made its first rate cut of the year, which is 25 basis points, in the 4 to 4.25% range, seen as a risk management move. To me, it's more than a risk management move, given weakening job market indicators. And markets are pricing in more easing towards the end of 2025 into 2026 now. And I also see in the US there is
Yeah.
a sort of a sector rotation and investor sentiment that has been changing. Housing and home builder stocks, consumer discretionary stocks catching up. Tech and growth names continue to lead in gains, but there is a lot of caution on this, and a lot of and some pockets there has been a bubbles with high valuations. Maybe that could be one of the thing in the coming weeks or months to see a sector rotation. And on the geopolitical trade with tariffs and foreign trade policy, there was some optimism around US China trade discussions again. Signals from Trump and Xi talks contributed to positive sentiment. At the same time, geoeconomic risks persist. Sanctions, trade policy changes, US revoking certain reliefs, and uncertainty around foreign relations still persists. On the currency, the US Treasury yields rose modestly. Long end yields and 10-year yields little moved up, pulling mortgage rates somewhat on a higher levels. The US dollar interest, though more or less on the same path, but it is going on a strengthening trajectory. And Ashwin, what I have realized, the last week, and a lot of central banks they have garnered a lot of activity
Yeah.
in the last. Besides the Fed, 15 central banks are in line to make policy announcements in the coming weeks. The key ones are, the Bank of England, European Central Bank, Bank of Japan. Markets are watching whether they hold cut or hint at, changes in the forward guidance. Inflation in many parts of Europe remains sticky. ECB has trimmed inflation forecasts, but it isn't signaling any cuts yet. So,
Yeah.
if we talk about the Bank of Japan, there is a significant policy shift which has unwinded a lot of ETFs and REITs in Japan.
Hmm, 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 hmm.
The Bank of Japan announced that it will begin unwinding its massive holdings of ETFs and REITs, a
Oh,
portfolio accumulated over years, and under ultra loose policy. I mean, because Japan has been under zero or negative rates for long period of time, so now it's the time
yeah.
for change, and the portfolio which was accumulated over those policies, seeing a significant change.
Yeah.
I mean, to put the figures into perspective, 250 billion yen in ETFs plus REIT annual unload will be happening through the pace, which is very gradual, and this will definitely avoid the disruption.
Correct.
On the what will have an implication is, why I'm stressing on this Bank of Japan is because of these policy changes and also what is happening in Japan. Global liquidity might tighten gradually, especially in the Asian region. Japanese investors pulling back from domestic asset purchases might look abroad, affecting cross-border flows. This might strengthen the yen for at least weaken less, but it will affect the Japanese exporters.
And
So this one signaling, I mean, along coupled with the Fed cuts, there is a FOMO push which we have seen. The U.S. Federal made its first rate cut, as I spoke, of 0.25 basis points. This also signaled possibly two more rate cuts before the year end, but the probability of that is very, very little. The cut was broadly anticipated, but markets treated it as a validation push to push the equities higher. There is evidence of FOMO, maybe the investors piling onto the risk assets, pushing indices to new heights. Again, if we see the same domestic moves in India, RBI and RBI has asked state governments to spread out their borrowings across different tenures. This is quite unusual, where RBI is making such a request to the state governments quite often. And we have seen many more. A lot of requests that has come from the RBI to the state governments in the last 2 3 months. So they are also suggesting not to overload long-term borrowing. States are planning record borrowings, 12 lakh crore to for FY26 to put numbers into perspective. What is the reason is that too much long-term issuance of high cost pushes up the yields, which it crowds out the private sector, causes yield curve distortions. The RBI is pushing for smoother, more predictable issuance and better schedule adherence. So why it matters is, the interest cost for both central and state government, which feed into inflation. The
Hmm.
inflation what we have seen is like, very mild inflation. It's not increasing, but to me, from Elysian, we feel that, central bank making such moves to state and central governments. That means it has got something in its mind where it feels that in the coming quarter the interest cost might be on a higher side. The sovereign yields tend to spill over corporate bond yields, consumer loan rates, which affects the banking sector margins. So we need to be a little cautious on these fronts. So all in all, I see. I mean, though U.S. markets are on a, making record highs every week, we see a lot of sector rotations, as said earlier. Little cautious on the text where there might be some pockets of bubbles, but of course we need to that might also get pushed up by the rate cuts, you know so we need to have a wait and watch and cautious policy as far as the global events are concerned in the coming weeks to go.
Fair enough, Prapanjan. So, I mean, like you said, there are a lot of global factors, especially when central banks are lining up with a lot of news. I think market will be keenly watching,
Yes.
which will kind of increase the volatility, because every good news can be negated by a bad news. So there's going to be a lot of volatility, and that's where investors and traders, especially traders, have to be very careful if they're going to get whipsawed on the trades on both sides. Gold and silver continue to show their strength, so there's absolutely not much changes there. And U.S. markets on the other side continue to show signs of resistance on the back of too many news that is making around the globe. So I think we'll just keep a watch on how the global factors pan out. Now, Prabhanjan, here is a question as an investor now, with the ability for you to invest in the US markets as well. And let's say you have an 100% of cash that is available right now. How much of portion of that would you be interested in deploying into US markets or global markets as an overall portfolio that you have?
To answer this question, I would wait to invest in the U.S. markets because it has been hitting all-time highs. We see lots of pockets of overstretched valuations over there. So I would definitely wait before rushing into U.S. markets. But yes, in the Asian markets, I would definitely look into. And of course, in India, uh, when the VIX is very low and it signals a lot of less volatility scenario. So I would always go for building a long-term portfolio in the Indian markets because Ashwin, we need to see one thing that when the global markets, including US and some of the Asian peers and European markets, were extremely performing good, it's only the Indian markets which was actually going around the corner. I mean, it was behaving completely in an aberrant fashion. So this is the time where we need to go long and accumulate the quality management stocks in India. So to answer your question, for US, I would wait. Maybe I would increase. In India, and Taiwan markets are also looking very good. So I would expose myself a little to the Taiwanese market.
Very good answer. I was just thinking that you will stick with the US and Europe, but I'm glad that you got in Taiwanese market. I mean, the kind of rally. I mean, I understand that we are one of the biggest markets, but there are certain pockets of the indices on the global front which have rallied 200, 300% in the last couple of quarters. I mean, those have got unnoticed because they are not major markets. But once the channel opens up, I mean, if you have fund of funds that is investing there, I think somebody should definitely take 5 or 10% sort of exposure, because we are so hell bent on, or obsessed with investing in US and European markets, we kind of forget what the other markets could do as well.
Absolutely, absolutely.
And how do you see the Indian markets for the next couple of days, Prapanjan?
See, to answer this question, I would like to touch on certain parameters, especially this week, if you see the India VIX, which plays a very important role in the investment horizon. India VIX has dropped as I said, to 9 levels. Why is it so low? We all need to understand why and what. Why is it so low? Means it instills the stability in the Indian markets and also instills the confidence in the Indian markets. I also see a less demand for protective options. That could be one of the reason why the volatility, the VIX is on a lower end. And if you see last 2 3 a month or so, there has been a little of a global calmness.
Yeah.
And there nothing, I don't say a calmness, but nothing much has deteriorated than what we saw
Correct. Correct.
you know and these are all favorable conditions, external conditions, for any volatility for any market, and this and I mean, of course, these might be one of the reasons for why the VIX is low. And what it signals, why what low VIX signals is higher investor confidence,
Yeah.
less of fear. Investors are willing to take more risk. Equities tend to perform when the volatility is low. Sectors with lesser riskier profiles, like growth, secular growth, tech, may benefit. But markets can be caught off guard. One single small trigger externally or internally, the market can just go out in a different direction. So, not always low VIX, it's a very favorable condition, but any trigger, any 10%, I mean, the VIX can move here and around 10, 15, 20% in a day. Low VIX can mask tail risk, but one external shock like geo policy, crude spikes could trigger very sharp moves. And it also signals, like, cheaper hedging options. Low
Yeah.
VIX, when there are low VIX, the hedging becomes very easier,
Correct.
cheaper. And also there is potential range bound moves with a limited upside. And
Yeah.
impact on, of course, it has an impact on the policy and RBI decisions. So these are the things which might play out because of the low volatility on that direction of the markets. So to me, we have to wait and watch on how the VIX plays out and how it has an impact on the inflation and how RBI, and as we rightly mentioned, more than 615 of the banks, they are releasing their guidance. So those are the things which will pan out in the next coming weeks. So I would rather, again, stick with quality stocks. If they are coming at reasonable valuations, we just go and pick them, make a rebalancing if it is required, and then stick with our portfolio. Stick with after rebalancing the portfolio, stick with the stocks for a long term perspective. For a short term perspective, I would wait and watch again for all the policy decisions to happen, to pan out, and then slowly start getting in on a short term basis.
Absolutely. I think I would echo your thought. I mean, it's okay to pay a premium to get into the right set of stocks or even at the right time, rather than trying to anticipate or speculate. And just because something is available at a discount does not necessarily mean that it is good. It's a value buy.
Absolutely,
And
absolutely.
the other thing I would want to highlight on again is the wicks being so low is can also be, while we might be too excited about it as an option trader. Yes, I have my bad moments there when you have such a low option. I mean, your uh,
Right.
premiums don't shoot up so easily. But the option wick squeeze is also something dangerous, because right now we are talking about a multi-year low that we are trading at. And
Yes.
one small trigger can just, I mean, we have seen wicks spike up by 40-50% in a day. I mean, these things have happened.
Right.
Well, the reason I brought this point up is somebody who is trading exclusively based on VIX should not be over excited about the markets, thinking that there is absolutely no fear in the market and just continue to make aggressive bets, but be a little cautious on the fact that market, VIX is trading at an all-time low. Sorry, multi-year low, and that could trigger a spike, which I mean, a simple correction of 1.5%, which the market can accept these days, is about 300 points, can shoot up the VIX by 30-40%. So your entire option, especially if you have sold into options, that could really damage your portfolio. Now,
Absolutely.
coming to the Nifty part, I'm just going to pull up the chart of Nifty. Very simple, straightforward. I have drawn a trend line from its previous lifetime high and then the recent high, and I've just connected the points. So until the breach of this trend line happens, I'm not too excited, not too ecstatic about the markets. The good thing is that in the last couple of weeks, after a multi-month consolidation, we have kind of back to touching that trend line, which is a good sign. A break of, while we all hope for a break of it, we should keenly monitor the volume data here, because any break of trend channels could also be a trap unless it is supported by good volumes. I am monitoring a couple of stocks which are kind of showing the signs of an impulse rally, but doing anything in anticipation, especially in the markets, can be a disastrous as well. So, like you rightly said, I would be okay to buy things at a premium, but wait for a couple of more sessions for the market to breach the trend line, simple trend line, supported by volumes. The leading stocks of Nifty or Nifty 50 or Nifty 100, leading the pack. Then it is right, and we can always buy into dips and make good money there. I am always wary and conscious of one thing: buying at the lowest point and selling at the highest point is practically not possible, and we should not even target it.
Yes, yes. You can't time
So
it.
you can't time it. I mean, even if we do this, we are not going to get a medal from the stock exchange saying that you were the best trader last year. So right. So it's ideal that when the momentum picks up, buy into those intraday dips. Like you rightly said, stick to your long-term stocks. In the short term, whatever has the best risk-reward ratio, get into them and see what additional alpha that these bets can generate for your portfolio. And I have one question. This is a practice that Lakshmi has got into this system. We have seen that in the last couple of trading sessions, I mean, even in fact, couple of weeks, auto stocks have done exceedingly well,
Right.
especially the trigger after the GST impact. Now, as an investor, as a fundamental research person, uh, would you be now that the auto stocks are doing extremely well, if I give you a choice, would you be excited to invest in auto stocks, or would you more look at auto ancillaries, which fall in the small and mid cap segment and can deliver you multifold returns than the big names of the auto industry? What would be your personal choice, Prabhanjan?
Right. So, in addition, our strategy is one thing, is like, buy right and sit right. That's the strategy we follow. What is right is, we again understand the what do you call it, as the pulse of the our clients, and then we invest. So in general, to talk about, we always believe that uh, the big stocks, or like big elephants, mota hathis, so there is very less room to make returns in those big stocks. uh, but of course there is safety in those stocks, but if we need to make good returns, barring one or two stocks, I'm not generalizing, barring one or two stocks, I would always go for small and mid cap stocks, not in the auto, but in the auto ancillaries, especially which are skewed towards the electric vehicles, not on the traditional vehicles, but on the electric vehicles. So my bet would always be on the auto ancillaries, which has got a misgiving towards the auto ancillary,
Electric.
the electric vehicles, and which has got a right proportion of domestic and export. sales
Ah,
growth,
got
because
it.
we should not forget that, if the stock is has completely has got is export oriented, then you are hit by what do you call it as the currency depreciation. So we need to
Yeah,
have right mix of
balance. Yes.
right balance, and then those are the stocks where we believe that you will get a very good 15 to 16% compounding year on year over a longer period of time, for more than 5 7 years. Then you will see a very good wealth that can be created. This and the short-term noises from the Trump, that drill baby drill, all those things will get blown away.
And then the good point, because you spoke about noise, it's been a couple of months since we started this series, and every time an investor, I mean, this is something that is a takeaway for everybody. Every time you want to make an investment decision, there is always one or the other noise in the market.
Right,
So you can never have 100% clarity
right,
in the haze that the market is, or the market is giving you. How you can find the right set of opportunities, have conviction in what you have invested, and most importantly have the courage and the sensibility, if it's
right,
not too harsh a word,
right.
to even juggle the portfolio or do tactical adjustment at the right point in time. I think that is what is the is the foundation of good investing, if you may ask me.
And one more point is to add. Absolutely, what all you mentioned is very right. One more point I would add is the patience. So the patience. I mean, you invest, you believe in a stock, give some time to the stock to perform.
Correct.
You can't allow the. I mean, you can't expect the stock to perform in 1 year or 2 years. I mean, just give that bit of a time. It's every stock has got a cycle. Be patient, believe an expert, be patient, and invest in that stock. I mean, you see the how Zomato's, how they have flared from 48 levels or 50s levels. Of course, a disclaimer: we are not suggesting any stock.
Yeah.
So, we need to give a time. We should have that patience. We should have right diversification. We should, and also we believe a concentrated portfolio. Of course,
Correct.
a zoo of stocks might not give you a big returns. It might not make you wealthier over a period of time, but
Correct.
a carefully curated, concentrated portfolio will really achieve multiple and multifold returns over a longer period of time.
Absolutely. I mean, total agreement with that. And a concentrated portfolio is always good, provided you have the right mix of stocks across different sectors. And you cannot be like, now that I've bought this stock, how dare it not go up? You cannot be
We can't be
dictating.
sentimental. We can't be emotional. I
Yeah.
mean, it's a stock. We are owning a part of the company, and we need to believe the management of the
It's a
company.
business that you're owning. So it's a
It's a
part of the
business. Yeah.
business that you're owning. Yeah.
Yeah, and I always say that it's like a business model. I mean, you cannot be so emotional towards it. If a product is not performing, then do get into a different product, right?
Okay.
So, I mean, that's why we need to move on. I mean, we can't just be attached to a particular stock and hold on for a longer period of time. You believed a
Absolutely.
particular model, you believed a particular path, it will perform. If it doesn't, due to X, Y, Z reasons, then you put a stop and move on. So that's
Correct.
how I mean, the thought process should be. And I feel one more point in these markets, which has calmed the sentiment, which has cheered the market sentiments, is the SEBI has cleared Adani Group from major allegations from the Indian
Yeah.
investors. You remember, like last 2 years onwards, and there's so much of noise. So I just remembered this since you mentioned about the word noise. I mean, this noise is also now gone away.
Gone
SEBI
away.
issued an accusation of share price manipulation and related party transactions that turbocharged the investors' confidence. And Adani stocks mainly being on the Nifty, so we also see a lot of Nifty going up, which Adani stocks also has contributed a lot.
Wonderful. That's a good cheer for the investors and people who have really accumulated Adani stocks on the fall were must have gotten very very good returns. So I'm very
Absolutely.
happy for them. Having said that, a quick disclaimer: none of these stocks or any particular opinion expressed constitute of any advice here. We're just trying to make investor understand the markets better and give our opinion about the market, but it need not be constituted as a investment advice. Please do consult your financial advisor and understand your risk tolerance and risk appetite before making any investment decisions. So until next time, do take care of yourself and your money in the markets, and hoping for a very good week ahead. And now that Dasera and Diwali is coming around, market historically have cheered, welcome the festival season with a big bang move. For the investors waiting this big bang move for a very, very long time, I hope you have your dreams realized. And nevertheless, take care of yourself and take care of your money prudently, and be cautious and understand your risk tolerance before making any investment decision. So, thank you, Prabhanjan, for your expert opinion. I hope to see you once again next week, along with Lakshmi leading the pack.
Absolutely, absolutely. And one point before we sign off,
Yeah,
if you have realized, Ashwin, this is the longest video, 31.08 seconds. So I wish Lakshmi should have been here. So this is the longest video in our series.
wonderful. I think uh, more points to be discussed. As we understand, you cannot fit everything into one single video, but there are a lot of points, lot of suggestions from viewers alike, saying that these are the points is something that you would want to cover, because these are not just we're not talking about just market for the week ahead or the next 10 to 15 trading sessions. We're also talking about certain investor awareness points that they need to keep in mind, or the sector analyzing that they need to work on before making any investment decision. So more such points will be covered in future, I assure you of that.
Absolutely, absolutely. Thank you so much. And thank you
Thank you,
also
Prabhajan.
to
Yeah,
our
yeah, bye.
investors. Bye bye.